March 1, 2012. Real Estate Capital Scoreboard March 2012. Chicago, Illinois, March 1, 2012. As the second quarter approaches, the real estate capital markets are nearly back to conditions that are more normal. Lenders are saddled with ample cash and many have cleaned their balance sheets, now looking for fresh new funding opportunities. General mortgage market conditions are outlined as follows. Mortgage rates, 3.85%, for very low leverage, to 4.75% for up to 65% leverage is a typical range for 10-year loans offered by life companies. 5% is a rough benchmark for where CMBS and higher leverage life companies are actively competing. 9 to 12% mezzanine and preferred equity funds available for funding debt above standard levels. Loan amounts and leverage, $8 million or more is a starting loan amount for capturing the most competitive funds. Smaller loans offered at pricing premiums of 25 basis points or more. 75% leverage is available from multiple sources for the highest quality retail and industrial properties. 65% to 70% is a benchmark for office properties. 80% is the maximum leverage for apartments based on CMBS and agency execution. With mezzanine financing, leverage levels approaching 90% are available for projects with ample cash flow. Underwriting, an overall debt yield of 9% to 11% applies for securitized loans, although the trend is to use rating agency LTV as a new benchmark. Debt service coverage ratios are much less relevant as interest rates are extremely low. Depending upon the lender, the cash-out discussions may be a factor, but more funding sources are becoming more liberal on this issue. Agencies are the most effective at lowest pricing with highest leverage. Life insurance companies are the price leaders, particularly for low leverage and flexible documentation. CMBS players returned, mostly picking off commercial properties in secondary markets or with projects seeking higher leverage. Observations: lenders' biggest concerns remain for finding projects that have sufficient cash flow. Again, rates are the lowest in modern history with 6% approaching high-risk pricing. A couple years ago, such rate would have been available to the highest quality projects. The Real Estate Capital Institute's Gene Peck notes, nearly every property sector is gradually recovering. For example, office buildings are now financeable with lower overall occupancy levels of 70 to 80% being more acceptable. In contrast, 90% was a benchmark for much of the past decade.